Hey everyone, Couch Investor back to another video for today. So we're starting the evening's earnings session with Intel earnings report, and then the next one will be about Amazon, so stay tuned for that. Now, as for Intel at the time of making this video, it's up 3.45% or so. They beat on their own expectations for this quarter. That does not mean that this was a good quarter. They just beat on their own expectations, which might have meant that they put the bar extremely low and in the hopes that they will beat it. In this case, it did work. We've actually talked about this a couple of quarters back. They should have done it with their own outlook already 3 quarters back, maybe sandbagging and then beating it, or at least meeting it. Has not happened before. Now, finally, they beat their own expectations. Wasn't such a great quarter, if you're asking me. Now, before we jump into that report, we had already Mobileye reporting earnings. That stock was down close to 16-17% today. Now, what happened? They also beat on earnings per share and revenue. So revenue grew 16% to $458 million in the first quarter. Diluted earnings per share was a loss of 10 cents, but adjusted diluted earnings per share non-GAAP was 14 cents for the first quarter. But that wasn't all. It's actually guidance that made the stock crash. So financial guidance for the 2023 fiscal year. We are updating our 2023 fiscal year guidance we provided on January 26, 2023 to reflect a meaningful reduction in our expectations for supervision volumes this year, which is impacting the midpoint of our annual revenue, operating loss, and adjusted operating income guidance by about 6.5%, 34%, and 6.5% respectively. The China electric vehicle market has been negatively impacted by meaningful pricing actions by a global EV OEM. I wonder who that is. It's Tesla for those that don't know. Reduction of government electric vehicle subsidies and general economic weakness in the country. Now, this resulted in the stock crashing 16%. Since its IPO, it has actually been performing quite okay. So overall, yes, it was maybe a good move for Intel to spin it off and IPO this business, but right now business is taking a hit because of a certain big EV player that, well, has a lot of competition and is now basically, well, destroying the pricing market. Now, before we jump into Intel's report, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, I would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Alright, so first a quick note here by Pat and by the CFO. So he says we delivered solid first quarter results representing the steady progress with our transformation. We hit key execution milestones in our data center roadmap and demonstrated the health of the process technology underpinning it. By the way, yes, we already talked about the milestone with the data center roadmap and the future product launches of it. If you want to watch those videos, it's going to be in the top right corner. But you will clearly see that in this report, that part of the business, unlike with AMD, as we will see later on, and NVIDIA, is not really performing that well currently. Anyways, while we remain cautious on the macroeconomic outlook, we are focused on what we can control as we deliver IDM 2.0, driving consistent execution across process and product roadmaps, and advancing our foundry business to best position us to capitalize on the $1 trillion market opportunity ahead. Then, the CFO, we exceeded our first quarter expectations on the top and bottom line and continued to be disciplined on expense management as part of our commitment to drive efficiencies and cost savings. At the same time, we are prioritizing the investments needed to advance our strategy and establish an internal foundry model, one of the most consequential steps we are taking to deliver on IDM 2.0. So of course, the milestones here, executing on strategy, we've covered that. You want to pause the video and look at it, be my guest. So, Q1 financial highlights. So revenue is down 36% year over year, came in at $11.7 billion, which is $0.7 billion above January outlook midpoint. Then gross margin 38.4%, that's down 14.7 percentage points year over year, and 0.6 percentage points below January outlook. And then EPS, a loss here, 4 cents, down 105% year over year, but 11 cents above January outlook. So again, it's basically, oh, it's bad, but it's better than what we feared, which still makes it not so good. Now, CCG, Client Computing Group, revenue is down here 38%, operating income is down 81%. Not surprised here, we already heard a couple of comments from Micron, from Apple, etc., etc. So no surprises here, and they knew this. They knew this was happening. My question is, how long is this going to take? Then Data Center and AI Group, we've talked about this as well. The roadmap, they're well on track. We're fine with that. I don't think we're going to see this part of the business grow like crazy in 2023, but I would like to exit 2023 with some accelerated growth, let's say, going into 2024. I think this should be feasible if they are really on track like they say they are. So revenue here is down 39%, operating income is down 137%. Now again, in the past, we've seen this segment perform badly for Intel, but then if you look at AMD and Nvidia specifically, they are doing quite fine. And if you can see here, revenue, the reason here, low revenue on TAM contraction and competitive pressure, more than none, it is competitive pressure. Then looking at Network and Edge Group, not really that significant, but here revenue is down 30% to $1.5 billion, operating income down 172%, operating margin of negative 20% for this quarter. And then the other businesses, we already talked about Mobileye. So here now IFS, Internal Foundry Services, revenue down to $118 million from $156 million. And operating income, the losses here have increased from $23 million to $140 million. They say your operating loss driven by increased spending to support strategic growth. Of course, we know this will take a lot of time to actually be pretty material to the overall business. And then the outlook for Q2, by the way, they're not giving us any outlook for the full year. So for Q2, they expect revenue to be down 22% year over year, to come in between $11.5 to $12.5 billion, which should be a bit better than this quarter, but gross margin is 1% less than this quarter, so 37.5%. It's also down 7.3 percentage points year over year, not great. Then as for EPS, flat quarter over quarter, but down 114% year over year. All right, so to conclude, and I'm not going to sugarcoat it, by the way, at the start of this video, the stock was up 2%. At the end of this video, the stock is currently down 2%. Why is that? Well, the points I made throughout this video now make a bit more sense. Now, again, while Q1 might have been the bottom, let's say, because we can see that Q2 will be a bit better when you look at revenue-wise, overall, still has a long way to go until it gets back on top. I'm not talking about generating close to, 18 billion dollars or so in revenue. That won't happen overnight. But you would like to see margins go up a bit more, EPS become, break even. Let's say, I know we're super close to break even, but to me, to feel a bit more comfortable adding more in this position, I would like to see more. And as I said, 2023 is a year of show me what you can do, and then let's see if I want to increase my position or not. Of course, those are just my thoughts. Leave yours down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the Amazon one. Bye-bye.